Report, June 2023, Managing Corporation Tax Inflows and Capacity Constraints. The key messages of this report are that after slowing over winter, Ireland's growth is recovering as inflation falls. But capacity constraints have emerged as a serious issue, with the jobs market exceptionally tight. The government's underlying deficit, that's the deficit excluding excess corporation tax receipts, is projected to narrow this year to 0.6% of GNI star this year and to return to surplus from next year. Excess corporation tax receipts add almost 3% of national income to get to the headline balance. And at the same time, the debt to GNI star ratio is on a downward path. One concern of the councils is that there are several methodological shortcomings in the fiscal projections. However, the key issue of this assessment report is that the public finances are being boosted by a large inflow of corporation tax receipts. As the council reported last week, 30% of these receipts are accounted for by the same three multinational companies. And at the same time, there are long-term challenges, including aging and climate change. In this Stability Programme update, the government has made important steps towards better long-term planning. In particular, the macroeconomic forecasts now extend to 2030. But at the same time, the fiscal forecasts end in 2026, which is the bare minimum required by the rule. Additional space for spending without offsetting tax measures or spending increases. This is not going to be easy to deliver. The proposed long-term savings vehicle the government has set out will help to manage corporation tax inflows. Saving these funds will help to balance the economy now and to finance future pensions. The government should also look at reinforcing the national spending rule as a first line of defence. Spending rules are helpful, but Ireland is likely to fall outside the scrutiny of the new EU fiscal rules. A domestic spending rule would help to focus on the medium-term management of the public finances. Turning now to the details of our assessment, let me start with the economic outlook. The economy has proven resilient. As you see in the left-hand chart here, successive real GNI star forecasts show there's been a successive upgrading of forecasts, and that includes an SPU 2023, partly as the winter has been less severe. The economy is set to continue to recover as inflation falls, as we see on the right-hand side, mostly due to energy prices. But there are many risks around the forecast, both in terms of inflation, which could either fall faster than expected, for example, if commodity prices would adjust more quickly, but could also be more persistent, and in terms of activity, where we have both very strong indicators on domestic activity, but some concerns about the risk of recession in the global economy. More muted, and the difference between the two obviously reflects high inflation. Maybe a bigger issue, at least in terms of numbers, is that we still think that consumption is probably much higher than is currently estimated by the CSO. If you look at the right-hand chart, you'll see the difference between household consumer expenditure in yellow and monthly VAT receipts. Typically, these numbers follow each other quite closely, but we've seen that quite a significant wedge has built up during the pandemic, and this is explored more in the note that you'll see the link to that we wrote some time ago with Kevin. This probably doesn't have a lot of impact on the growth rates, but it does mean that we're starting from a different starting position, and probably that the very high reported level of household savings is in reality probably significantly lower. One of the big themes to emerge as the economy has recovered from the energy crisis and from the pandemic is that capacity constraints in the economy are becoming much more binding. The labour economy is very tight. We have essentially record low unemployment. The employment to population ratio is unusually high. There are now 2.6 million people in work. One of the factors driving on domestic activity is some of the activities of the foreign-owned multinational sector, including the employment and the high incomes that they're bringing to Ireland, as well as some of the corporation tax money that's being spent by the government. In the longer run, the size of this sector and its development may distort patterns of activity across different sectors. So this is something the government has to be very mindful about. It's also bringing strong demand for labour, which is supporting inward migration, which both has the advantage of adding to the supply of the economy, but does contribute to demand as well. And of course, one key area of this is that the shortage of housing is a key constraint on the economy at this point. Strong growth in the economy and persistent low housing investment that you can see in this left-hand chart. Ireland spent most of the decade amongst the countries with lowest housing investment. This has led to a large shortfall in the housing stock. There aren't enough dwellings. And a large increase in the workforce would be needed to accelerate investment. And this is something we looked at in recent years. In the note, at the peak, there were almost twice as many people working in construction as there are today. So this is a big challenge for the economy and means that rents and house prices are likely to remain high for some time. One welcome development in the SPU is the extension of the forecast horizon, 2030. This is something that the Council has consistently called for, because long-term projections should support better planning and help us better to understand the world in which we're going to go and how we should set the public finances, how we should chart a course for the public finances in the years ahead. The forecast that you see, which is based on a quite similar methodology to the one the Council has used, basically show that the underlying growth rate of the economy is somewhere around 2.5% in the years ahead, but that's expected to slow towards 2030, partly as the effect of aging kicks in and we have slower population growth. One of the advantages of these long-term projections is we could look at some of the things that we know are going to happen. So in the right-hand chart, you see what the SPU forecasts in terms of the increase in household savings will be due to auto-enrollment. The idea of auto-enrollment being that if people are enrolled into these schemes automatically, some of them will save that money rather than spending it. And that will lead to some steady rise in the household savings ratio in the years ahead. So it's very useful to have these long-term projections. Turning now to the budgetary outlook, the public finances are on an improving path, and that's helped in part by these exceptional corporation tax receipts. The SPU forecasts an underlying general government deficit, so that's excluding the part of windfall taxes estimated by the Department of Finance, forecasts a deficit this year of 0.6% of national income. And that will turn to a surplus next year. So that's the first time we're in surplus on this measure for some 17 years. And you can see it's part of this longer trend improvement in the underlying position of public finances. And on top of this, in terms of the headline balance, you have about another 3% of national income each year being added by this excess part of corporation tax receipts. Of course, that's very uncertain. The Council has a number of concerns in the SPU about the way the methodology has been developed. The most serious concern is the first one, which is that the forecast horizon for the budgetary projections hasn't been extended to 2023. It remains at 2026, which is kind of the minimum that's required. And it's basically too short, really, to give us a good picture of some of the underlying pressures the public finances will face, like aging, climate change, auto-enrollment, and other factors. And then there are a number of specific issues in the methodology that are unsatisfactory. One is that there's no provision beyond this year for Ukrainian refugees or the migrant redress scheme. The second is that the costs of auto-enrollment and the Christmas bonus aren't factored into these projections. The third is that PRSI receipts forecasts are essentially out of date. If you look at the chart on the left, you can see we're 8% ahead of the profile at this time, but the forecasts haven't been revised since the budget. And the approach to social contributions more generally, this is explained in a box in the text, is flawed, which leads to quite large errors. Now, taken together, none of these things would fundamentally change the way that we look at the budget, but there are some significant errors there. And it's obviously a good practice that the government should try and reduce these kind of avoidable forecast errors as much as possible. Now, one aspect that's been very important in the management of the energy crisis and the pandemic has been the use of contingencies. So in the budget, the government sets out an amount, doesn't say exactly how and when it's going to use it, but that gives it a kind of buffer to deal with these crises. And that approach has been very successful. There's still around $1 billion of non-core spending that has to be yet to be allocated for this year. So the contingencies haven't been fully used, but of the original 5, actually around 80% have already been committed. And then we do see a number of short-term pressures in the public finances, particularly around services required to support refugees and also around health. One issue here is that the funding of the February package, when it was announced, was very unclear. It seems that the government subsequently told us that it's drawing on a mixture of savings from other schemes and on higher tax revenues. But it's important for the government to be transparent about these things when it's announced. And ultimately, this was the kind of thing that contingencies were designed to do. And so the government really should have used the contingencies for that purpose to be consistent with its framework. More generally, the government should be very transparent on how all new spending announcements are going to be funded relative to government plans. So we often hear that the government's going to spend another 100 million on this, another 50 million on this. It would be very useful in terms of transparency for the government systematically to explain where that's coming from. By and large, that money is either coming from within existing budgets or money that was not allocated on budget day and then is subsequently allocated through the year. But the government needs to explain why that is. That's both so we can understand whether these announcements actually have any impact on the forecast for the budget deficit or balance, or whether it's already included. I think it's also helpful in terms of people understanding that the public finances are managed in a structured way and not just sort of ad hoc spending announcements. Turning back to the revenue side, so revenue growth has been very strong. Income tax is well above the pre-pandemic trend by around 20% in May. VAT receipts have been a little bit more muted in recent months, but are still well above the pre-pandemic trend. And we saw a lot of strength earlier in the year in terms of corporation tax receipts. The March intake was very, very strong. Since then, the news has been a bit weaker, but this probably suggests that over the year, there will be an increase in corporation tax receipts relative to last year. Looking at the specific role of income tax, which is obviously very important as a tax head, if we start on the right-hand side, we see these green bars show the amount that would be needed to fully index the income tax system. So that's to fully account for the fact that with higher nominal incomes, more people would be dragged into higher tax brackets. And that number in the next couple of years is around €1 billion. The government has set out in the SPU policy measures of around 500 billion, reductions in 500 billion. So that would mean that net, we would still have a positive increase in income taxes as a result of these changes, although by less than full indexation. So we have partial indexation. As a result of that, on the left-hand side, what you actually see is a slight fall in the share of income tax relative to compensation. And that's because in addition to this assumption of partial indexation, the government is also assuming some kind of is applying a negative judgment. Basically, corporation income tax receipts have been very buoyant in the past couple of years, particularly because of pay and an increase in employment in the ICT sector. They're kind of expecting that to unwind a bit. Overall, it's basically fairly flat and at a higher level than it was in previous years. There is a balance going on here between this negative judgment and this partial indexation. In terms of corporation tax, we've seen these have increased sharply. If you look on the left-hand side, you see where that change comes from. It's essentially being driven by foreign nationals. Some of it is in this component that's viewed as a kind of core component. Most of it, particularly last year, was in terms of windfalls. And as a result of that, you see that over the past couple of years, the share of general government revenue in national income has been pretty flat. But if you exclude the excess corporation tax, and there's been a divergence with the excess component building up, so that there's now quite a substantial range. In terms of corporation tax, as I'm sure you're aware, the Council, and you can see the link here, published new work last week that used publicly available information to try and understand what was happening a bit more within the corporation tax. What that work suggested is that 3 corporate groups accounted for around almost a third, 30% of all corporation tax receipts over the past 5 years. This is very heavily dominated, as you might expect, by the farm, chem, and ICT sectors, which account for almost all of the corporation tax paid by the top 10. This obviously leaves Ireland very exposed to the developments in these 3 firms, to firm risks, leaves it exposed to sector risks, and of course it leaves it dependent on developments in the international tax policy area as well. On the spending side, if you look at the spending increases, which are represented by the gold dots on this chart, the government is planning to stick to the national spending rule, and you see what that would mean. That means they have around 4 billion to spend in this budget. However, this is actually going to be fairly challenging, because if you look at the government's capital spending plans, which is the dark part, if you look at the government's own measures of the existing level of service, which is essentially the pink part, and then the cost of indexation basically to wages, you get up to a higher number. So there's a gap of about 1 billion over this year and next year between what full indexation would cost and the amount the government has set aside. Now, the government does have a number of options here. In the past, it hasn't always fully indexed on the spending side. It hasn't always fully indexed on the tax side, and those could generate more space. But the government is going to have to choose between existing spending programs, new spending, and tax measures if it wants to comply with the spending rule. On the capital side, which is obviously a very important part, the investment budget remains very large. We're still spending a relatively high share of our national income compared to other countries and compared to historically, but the money actually hasn't fully been spent. So if you look at the left-hand side, you can see repeated forecasts for capital spending, and you can see that they've shifted downwards. That is partly because the nominal amount of spending has been shifted downwards. The government hasn't always spent as much as it planned to, and it's revised down its future plans as a result. It's also driven by the fact that there's been a lot of cost inflation in that sector, so the volume increase in spending is much less than was originally anticipated. And of course, this interacts with the capacity constraints. There's a risk if we try and spend more, we'll push the prices higher, and we won't get a lot more investment for our money. Drawing it all together, as we discussed earlier, the government's moving back into a surplus on the underlying basis. If we look at the debt to GNI star forecast in gross terms, we see there's a consistent downward revision to the debt profiles, and we see that debt is on a fairly steep trajectory, so it'll be going from around 80% today in gross terms to around 65% by 2020-60 as a share of GNI star. As the right-hand chart shows, a lot of that is actually driven by corporation tax receipts, which are the darker pink bars at the bottom. That accounts for around 2/3 of the reduction in debt that's anticipated over this period. Turning to the Fiscal Council's assessment of the fiscal stance and the fiscal framework, the government is going to have to manage in the coming years and in the budget quite a complicated situation with capacity constraints. It needs to reduce debt, and it needs to manage the corporation tax inflows. On the left-hand chart, you can see that activity measured by the output gap is expected to remain close to potential, but more on the side of the overheating. This is the council's assessment of that, but it's consistent with what we say about capacity constraints. In the middle panel, we see that while the debt ratio is falling, at the moment it's actually still relatively high compared to small advanced economies. So it's very important that we use that window of opportunity that we have to bring debt down to a more prudent level where we'll be less exposed to potential risks. And on the right-hand side, corporation taxes brings a number of risks. One of the big things that might change is that there would be a potential, the debt ratio would be falling more slowly. So we are very dependent on that at the moment for reductions in debt. So the government in the year ahead should stick to national spending rule. This is what they did in budget 2023, and that struck an appropriate balance at the time between helping households to manage the energy crisis and avoiding higher inflation. For 2024, they should really do the same thing. The main reason for that is to avoid putting additional pressure on capacity and constraints and demand in the economy that might lead to higher inflation, more overheating, and more pressure on things like housing. As we just discussed, to achieve this will require choices between tax and spending. And spending more of the excess corporation tax than we are today would really magnify these risks in terms of overheating. The proposals to create a new long-term savings vehicle, a new reserve fund, are welcome. This would help to reduce a reliance on the unstable corporation tax receipts and adding to demand in the economy. It would also help to address this issue of the long-term sustainability of the pension system, which is not really assured as we speak. And it could also help Ireland to build a large fund that would help to diversify risks and benefit future generations. The Council put out a working paper that you can see here earlier in the year that discussed one way of doing this. The Department of Finance more recently set out a proposal. This suggests that around 40% of the ageing costs could be covered under some assumptions out of the revenues of this fund over a period. So it could help. It doesn't completely deal with the demographic problem, but it shows how we can use this money to ease the future challenges that we face around demographics. So essentially, and I think follows neatly from these points about saving for the future, Ireland really does need to improve how it plans for the long term. We're facing these very big pressures, and you can see them on the right, primarily coming from aging and pension costs, but also from climate change, from the cost of implementation of launch care and healthcare pressures in general, and from the possibility that we may want to increase defence spending at a time when many other countries are doing that as well. And I think, and all these challenges are happening at the same time, which makes it particularly challenging. And that's why it would be important to have better long-term fiscal projections, so we can see how these things interplay even over the next decades. That's why more structural solutions, for example, like a long-term savings vehicle, would help on savings and pensions. On climate change, we still don't really know how much it's going to cost, and it'd be very important for the government to make progress on the costing of that. The same is true of launch account. Something that can help with this long-term planning is having a very solid, sound, long-term framework for planning for managing the public finances. Fiscal rules can be very helpful in this context, and Ireland has traditionally been quite dependent on the EU fiscal rules. But actually, Ireland's unlikely to come under much scrutiny under the proposed new EU fiscal rules that come from the Commission. That's partly because it continues to rely on GDP-based measures, which are not appropriate for Ireland, but make us look like we're very good. It's also that Ireland's budget balance and debt trajectory is actually on a relatively healthy path. So I think in that context, given that EU scrutiny will in some ways be less than it was in the past, it's particularly important to keep developing the national spending rules, the kind of first line of defense, knowing that the EU rules are not necessarily going to provide that. The national spending rule, which was set out in 2021, sets a limit to spending growth to keep it in line with the trend growth of GNI style, which is essentially the trend growth of revenue. The government has now made it clear that this is a net spending rule, so that an increase in taxes allows for additional spending. And that's clearly a very sensible way of doing it, so that it's not skewed in a particular way, and nicely illustrates the trade-offs the governments face between higher taxation and higher spending. The rule has played a very helpful role, in our view, in helping to anchor spending during the cost of living crisis. If you look at the path on the left-hand side, it shows net policy spending, so that's a suggested amount that you would get under the 5% path in the dotted line, and what the government has achieved and planned. And you can see that it's broadly on track. Despite the fact that the government gave itself a bit of extra leeway last year, that partly compensated for running policy a little bit tighter in the previous years. The government also didn't fully spend what it had allocated. So we're actually pretty much on track, which I think is very helpful. This rule should be refined and key elements set out in law. This would help to make it clearer and more transparent to everyone how it's supposed to work and help to encourage buy-in. There's more discussion of this in the note that you see a link to there. Successful examples of how this kind of system can work in the Netherlands and Sweden highlight many useful things about these rules. But one, I think, is the importance of political buy-in across the system. There can be very different views politically about whether spending in one area or another, or taxation are the priorities. But what shouldn't really be negotiable is the sustainability of the public finances. And that's what these very solid systems like those in the Netherlands and Sweden have achieved. So to summarize the key messages, the economy is set to recover, but there are strong capacity constraints and many risks. The government's underlying deficit is projected to have a deficit of 0.6% this year and to return to surplus from next year. The public finances are being boosted by a large inflow of corporation tax receipts, but there are major challenges, partly about the management of those receipts, but also in terms of sustaining the pension system and tackling climate change. The government has made some important steps towards long-term planning in this SBU, but a number of issues remain, particularly the short horizon for the fiscal projections. In terms of policy, following the national spending rule is appropriate for prudent management of the public finances, particularly in the light of the strong capacity constraints. The proposed long-term savings vehicle, the reserve fund, would help to manage corporation tax inflows, and the government should reinforce the national spending rule as a first line of defense. Thank you for listening, and I look forward to your questions.